So I will be going long on Euro USD. I just want to drag your attention to these highs. So for every candlestick, you have an open. So hang on. So when a candlestick opens, so say we are bullish, right? Say we are just give me 1 second. So when we are bullish on um when you have a candlestick, right? The candle opens. So if we have a bullish candle, the candle opens at the low. The candle opens here, expands downwards, forms the low of the candle, expands back up to form the very high. Then it will then close around somewhere close to the high or kind of close to the high. So having said that, you know, I want to drag your attention to this very smooth highs. Now, there's one thing you should know, that there is no straight line in the market. There is no, the algorithm does will always refer back to levels like this. So if you look over here on my chart, it shows you the open, high, low, and close of each candle. Um, so that's the high. So if you keep your eyes on this number here to show you the very high of the candle. So so this is a new day. This is a Monday, and you see this high. The high comes in at 1.08587. So just keep track of the last digit. So that's 8587. Now I want to drag your attention to these candles over here. What's the high there? 8587. And what's the high on this candle? Right beside it. Keep your eyes over here. Keep your eyes over here. 8587. So this is literally a straight line. Now, when you see this, that is a target. I don't care what your bias is. I don't care what you feel might be happening. That in itself, that's how you know there's real orders resting here. Real, there are there are unwilling sellers up here. So there are willing buyers above this. My bad. There are willing buyers above this level. So why do I say that? I've said this again and I'll say it again. When someone goes short here to sell this, to come out of a short position, you have to buy that back in the form, you have to come out of that position in the form of a buy stop. You have to buy your position back. So if somebody sold here, John sold from here up, where would their stop loss be? Where would their stop loss want to be? They're going to say, oh, it came up here once, rejected, came up here once, rejected, again, rejected. So they will see this as a safe, they'll see this as resistance, as something safe to trust. Hence, their stop loss will be there. So a stop loss is to protect your position is to protect you from further losses. So if they are buying this back to protect their position, someone else is selling this, selling into that buying. So for every buyer, there's a seller. So that is the logic that goes on every day, every week, every year, month out. It's never going to stop. This is how the market works. And you might not be able to see this every time. You need some practice to see this in real time as it's happening, but over time to get easier, and you will have losses, but I'll do a separate video on managing losses and managing your expectations. So with that being said, we see the market rally. So the London session is over, and the London session spans from 2 o'clock New York time to about the London AM session. So about, I think it's about 6 a.m. New York time. So this is the London session. This is the London AM session. So that's what the London session has done. So the London session has rallied down. So we can expect price to come back up in the New York session to take this out. Now, initially I did not want to trade on Monday. I did not want to trade today. But having seen this signature, this is not random. It's not, it's not it's not just guessing. Like, this is a specific level that has been referred to the tick several times. One, two, three, and four. Four times that this level has been referred to. So that's alone. I'm long-term bearish on the Euro USD. I'm bearish. But if I'm bearish, I'm expecting lower prices. They have to price it to a premium. They have to drag it up to one, cause damage to those above here. Two, to generate liquidity to actually get in those short positions. So that is why you can trade it up there. You can trade the rally up into that liquidity and short from there downwards into the your higher time frame objective. So that's a bit advanced. It's a bit it requires a bit more experience to do, and I wouldn't recommend that. If you're bearish long term, I would say try taking only trades in that direction. Trying to go counter trend can be a bit it requires a bit more experience in my opinion. So I wouldn't say go for that. I've been doing this for a while, so that's why I'm able to see this before time and actually execute on it. So the logic framing the entry was that, even if it's rallied down, my duty as a trader is not to catch the low. I'm not trying to trade from here. I'm not trying to buy from here. I'm waiting for the New York. I'm waiting for time to align. I'm waiting for a specific time. So what specific time am I referring to? So the New York session starts from 7 in the morning New York time to about 11. I don't like taking trades after 11. So it's about 11 in the morning. So that's the New York AM session. So that's the AM session for New York. And it starts here, but there's no setup. It just keeps rallying, keeps rallying. You don't chase this. You never try and chase this. So you're waiting for what does the rule say? You're waiting for sell side to be taken, a low to be swept. Then you're waiting for a market structure shift. That means a swing high. What's a swing high? A swing high is this: when you have three candles like this, three consecutive candles, where the middle candle, the second candle, has a higher wick or a higher high than the two candles to the side of it. So this 1, 2, 3 is what you would call a swing high. So we have that here. You have one here and you have one here. So 1, 2, 3 swing high. 1, 2, 3 swing high. So when you have this and price closes above that with displacement, see this gap. See this gap over here. See this gap. When it closes above that with speed, that is your displacement. So one, sell side taking one. Two, you have a market structural shift. Was it slow? Was it up, down? It was one way. It was quick once. That's how you know that, okay, it's like an elephant stepping into a pool. I will always use this analogy. You guys get tired of this. When something big falls in a pool, you cannot miss it. It will displace the water that's there. So that is the displacement I'm talking about. This one-way expansion up. The fact you have this, does it still mean you should trade it? No, you wait. You wait a bit and price retraces back down. It will always try and fill up the imbalance. So it fills that back down. And what's this right here? Before the expansion up, what did we have? Two consecutive down close candles. So 1, 2, 1, 2. So the opening price of those, where the down close candle happened, and I like this order block because it took out this low right here. It stopped out those that were making money up, took them out. So if you're in a long position, if you're buying, how do you come out of a buy position? If you're a bull, you've bought, how do you make your profit on that? Or how do you come out of that position? You sell it back. And for every seller, there's a buyer, and smart money is interested in buying below this. So once their stop loss have been raided, because they'll put their stop below this, their stop loss have been raided. So they are now, whether they like it or not, they are now forced to sell. And that sell is a counterparty to smart money's buy down here, and hence the expansion up. So that's why I like these two down close candles. That's why an order block. Now this, I'm going to say something that's going to fly over your head, but if you really pay attention to this, you can avoid a lot of losing trades. Now, this order block, where is this order block? Is it at a random position? No, it's in another fair value gap. So you have this right here. So this one pass up, then the third candle, this one pass up, this imbalance. That is once you have this, you have a high probability setup. An order block in a fair value gap, and watch how it aligns with the midpoints, the consequent encroachment of the fair value gap. Look, there is a middle line on the fair value gap. There's a line, and watch how, see how the order block is directly at the middle. When you see this certain, once you see signatures like this in price, your you have a higher chance of being right. You have a higher chance of being on side. And look at the bodies. The wicks do the damage. The bodies tell the story. The bodies close above the order block. That's how you know a high probability order block. It feels like a lot, I understand, but keep showing up, keep coming, keep taking down notes. I promise you, I promise it will get easier along the way. So you want to be a buyer in here, preferably at this order block level. Or if you feel this is too scary to do, you could be a buyer up here. This is still a fair value gap. Where would your stop loss be? Your stop loss would be after the damage has been done here or below the order block. So your stop loss should be a safe. When you're placing your stop loss, you should place it as a very safe position where ideally where damage has been done, where they are unlikely to revisit again. So having stopped out the traders that got, you know, that got stuck in this chop here, right here, you can place your stop loss below that. And as price rallies, you can then trim it. You can take up the risk slowly. I'm not trying to jam my stop loss up there. No, I'm taking down, I'm slowly reducing the risk. So you can give the trade breathing room to go up, down. Now this could potentially be an imbalance. So from this candle to this candle is about to close, so this could be an imbalance. The price will have to balance. So I wouldn't jam my stop loss all the way up here because that is not giving the trade breathing room to move. So where would I be aiming for? Ultimately, I'm aiming for the buy side above this level. So that's the 1.08587 level. That's what I'll be aiming for. But you can take partials. I'll be taking partials above this high right there. So I know there's liquidity above old highs. That's just it. There's always liquidity above old highs, or old highs are reasonable targets to aim for when bullish. So this can be minor buy side liquidity. Minor buy side. So I'll be taking a partial off here once price gets there, and I don't think we need this anymore. So with that logic, we can and see how these highs are in close proximity. So this high and this high, it's very close. They're probably going to run through these levels, and when you have consecutive highs lined up like this, they tend to go through them with speed and just a quick expansion towards that. That's what I'm in my mind. That's what I'm expecting. So so just to sit back and really kind of watch what price is doing. You're not understand you're doing this for the money, but primarily you're not focusing on the money. You're not focusing on your PNL. Notice when I put on this position, go back, rewind the video, it's a 1% risk. That is what I'm willing to risk. That's what I'm okay risking. So as long as you're okay with your risk, you should risk what you're comfortable losing so that your mind is not poisoned to always focus on your PNL because it will always go up and down. But you're primarily focusing on what price is doing at that given moment. So we've just passed the 9 o'clock hour, and we have news at 10. So oftentimes these news events will be used as a smoke screen, as an excuse. I couldn't care what these numbers mean. I really couldn't care what these numbers mean because either way they will be used to manipulate price to where price is likely to go to, which is what I've pointed out here. This relative equal highs here. So um so yeah, I think we'll be needing this anymore. So this fair value gap is a fair value gap on the 3 minute time frame. So if you drop down to the 3 minute time frame, this is actually a gap in itself, and we have another gap up here. So I'm trying not to mark up my chart too much, but when bullish, I'm just gonna type this down so it doesn't fly over your head. When bullish, we want to see bullish fair value gap supports price, and down close candles supports price as well. So when bullish, I'm expecting higher prices. Any form of, you know, one way up movement, a bullish fair value gap, it should support price, like what this did here and this one here, and now this fair value gap we are currently inside of. So it's 1, 2, 3. So this fair value gap right here, this one, it should support price. I do not want to see price going all the way down here and closing below this fair value gap. Then it means our trade idea is probably not right, and we should probably close the trade or take a partial. But generally, we are just watching. We're not trying to predict anything. We are expecting something. We are expecting something to play out, but we're not demanding that be its be all end all. That's the final outcome, because you have to be flexible when trading. You can't marry an idea. You have to pay attention to what's actually going on. So this is a down close candle. So I'm willing to allow price to trade to that. I'm just going to extend that out in time. So this could be an order block on a lower time frame. So let me extend that out in time. Just what, again, paying attention to the bodies and the wicks coming down to a random level, to the midpoint of the fair value gap, and how the bodies are closing above the fair value gap relative to the 3 minute time frame. So always have this in mind when you're a bull, when you're bullish. When bullish, we want to see bullish fair value gaps support price, and down close candles support price. Now it didn't get all the way down there, but if it had, that would have been fine. It's permissible, it's all right. Same thing here, down close candles supporting price, down close candles supporting price when bullish. So it's gonna drop down to go down back out to the 5 minute time frame. Observe how I'm not in a rush to jam my stop loss up. I'm still allowing, it's gradual. You gradually bring your stop loss to minimize the risk. So now what would have been before a $600 risk now has been reduced to 100. So this is how you want to trade. You want to trade in a way where as your profits grow, as your profits are increasing, as the market's going in your direction, you're gradually removing the risk from the trade until eventually your stop loss is now in profits, and that removes every form of emotion from your trading, which is what you should aim for. You're managing yourself. By doing that, you're managing yourself, you're managing your money, you're managing your expectations, you're managing your equity, because that equity is what you're going to use. You don't want to burn through everything in one day or burn through half of it in a day, have a losing trade that takes half of your account. You do not want that, because that's just mental baggage. That is very difficult to come back from. It's very difficult to have that as a trader. So you want to take it slowly. You want to protect what you have. Number one priority is to protect your money, then protect yourself, protect your mindset, protect your expectations, manage all of that. So it's an all-in-one thing. You're doing a lot at the same time. So that's why you have to trade. You have to be in a proper frame of mind to be able to do this, to put money on the line, to manage it, manage yourself, and manage your money. It takes a lot, but with time it becomes easier. It doesn't become easy, but it becomes easier, if that makes sense. So I'm currently watching how price trades above this high. I'm expecting an expansion through. I'm expecting a rapid movement up through there, but um, I haven't actually had my breakfast this morning. I've not had any breakfast. I've not eaten, so I will try go to the kitchen and grab something to eat real quick. Um, but I'll just leave my annotations on. Um, I'll leave it on. So that level, I'm watching this level. This is where my focus is. So see how just go back from the kitchen and see how price trades above this high. I like the fact that it's closed above it. So that signifies to me in my mind when I see this, I know now that this is more of a this is a reachable target. The fact that we're closing above this high. If we had wicked past this and stayed below, I might have taken a partial off here. But the fact that we're closing above it, oh, okay, there we go. The fact we're closing above it means that we're probably going to reach for this and potentially this in the long run. So my stop loss can move to above break even. So now the trade is risk free, and I'll be looking to offload some of my positions. So I've got just gonna be take a partial off there. So you can see where I've gotten from. I've gotten here and taking a partial here. I'm looking to take one more, close the final position above there. So just hop out and take a look at the GBP USD. Now the euro dollar and the pound dollar, they are closely correlated, but sometimes you see that they are both bullish short term, but the price action will oftentimes be cleaner in one of them. So you have the euro USD and the GBP USD. Now the GBP USD pound dollar is consolidated. It's not as clean, it's not, you don't see the setup as cleanly here. I mean, there is a fair value gap here, but I'll touch on correlations in another video. But for the sake of brevity, and it's just a trade execution showing you the nuts and bolts straight to the point. But you can see that sometimes one might be a bit choppy and not so clear where to aim for. There's no smooth high to aim for. But on the euro dollar, you see that you have your, it's there, it's written, they're not hiding their footprint, it's there, you can see it, you can see the setup, you can see the gap and everything. It's clearer on here. So just to try out there, in case you're feeling a bit frustrated, sometimes looking at an asset class, try looking at a closely correlated asset class and see, maybe the one you're trying to trade is not as clean, it's not where the setup is, and that's okay, that's fine. Even if you miss the move, you just journal it, you write it down as though you took the trade, and look at it at a later time, refer back to it. So that's just a tip for those that might be stuck on that. And look at the Nasdaq real quick. say 1 hour time frame. So oftentimes forex and equities tend to move up simultaneously. So when the Nasdaq is going up, you can expect the pound to be going up and the euro to be going up as well. So, and note also, I'm just gonna switch up the drawing. So this is still the the euro dollar, but note these equal highs we outlined these very smooth highs. Note how that is also what's resting beside it. A sell side imbalance, buy side inefficiency, a CB. So it's a fair value gap, but not bullish, is bearish. So this is actually a balanced price range. So when you have price go one way up, one way down, and a bullish fair value gap overlaps with a bearish fair value gap, that range, this from this to this, is a very balanced price range. You can, if price trades up there, you're going to have difficulty going past there. So you can see how a lot of things come together to arrive at a. It's not just wake up every morning and, I mean, you can trade every morning, but it's not just willy nilly. Like you have to have narrative. You have to know why this is doing what it's doing. You can see, so your understanding has to be layered. It has to this on this on that on this. So that's something that I can't compress into a video or a series of videos. Like you have to show up, experience them for yourself, take notes, and allow time to pass so that these things can become more obvious to you. You won't have to struggle to find them. So we have an imbalance above that price never reached. It came close, but it never reached it. Plus the very smooth highs, plus the fact that it's in a discount. So if you measure your fib, if you measure the distance from that high to this low, it's in a discount. So above the 50% level is a premium, below the 50% level is a discount. So price is currently in a discount. So you see these things come together, blended together. You have to have a valid trade idea. So, and on the 15-minute time frame, you can see that fair value gap is transposed to be this as well, which is still above the buy side liquidity. So this can be a good price point to aim for in terms of targeting as you're bullish. And then from there, I'm not saying this is a trade idea to go short from. I do not know. It could go further. I'm not trying to encourage you to try and do this. Once it trades back up here, you start shorting it. You wait for confirmation. You wait for certain signatures in price to show you. And just like how we saw this, we saw the signature in price, we saw the other blocks respecting price, how the bodies were closing above. Those are signatures that if you're not writing them down, if you're not taking notes of them, you will forget and you get frustrated. And so yeah, let's hop back into the trade. This is literally we are looking for the same thing over and over again. It's nothing. We're looking for the same thing over and over again. It's never. Your trading shouldn't be very exciting. Shouldn't be too exciting. You might see one or two interesting things, but it shouldn't. Generally, should be the same thing you're looking for every time. So that way you have a baseline, you have something to trust, you have rules, you have a code of conduct while trading. If this happens, then that, then this happens, then that. So it's very layered. You're not gambling, you're not seeing what happens. You know what you're looking for, you know what you're hunting down. So now we have one, two, three, four consecutive down close candles that took out these lows, balance and inefficiency, and rallied back up. So we can expect if price comes down here to this, the opening price of the first up close candle, if you extend that out in time, that can act as an order block, as a support level, quote unquote, not support and resistance, as a level that price might bounce off of. Same thing that happened here. It came down, bounced off there. Same thing happened there. You can allow your stop loss for this in case it comes back down. It might not. But the point is your stop loss shouldn't be jammed up too high so that the trade can have breathing space. So this is the part of the trade where it's oftentimes when you have these kind of equal highs, you see the trade tends to really accelerate to those levels, like really move with speed, and you're at a position where you've taken something, you've taken a position off, you've paid yourself, your stop loss is above break even. So even if something happens and price were to revert all the way down, which I highly doubt, you're still in profit. The point of this is to make profits. You're not trying to be a magician or an Olympic perform. No, no, no. You're doing this to make a profit. Once you get your profits, your reasonable profit, your logical profit based on sound logic that I've outlined here. See how everything was logical. I get in my stop loss, everything makes sense. It should make sense, and only then will you be satisfied with your trade. If you're not following any kind of logic, you're going to feel like you're gambling. It's going to feel scary, but it should be a calm thing. Once you do this over time, is it becomes it becomes repetitive in the sense that you're not having memory, you're having muscle memory. Your mind can retain things now because you've been doing it for a long time, and it will get it will get ever so easier for you to do. So my focus is up here. I'm looking for price to get to trade up to that level, and here we're creating new equity highs. So I'm just gonna show my stop loss ever so slightly. So really gloomy weather today. It's not particularly bright in Manchester, but now I don't particularly drop down to the 1 minute time frame every time, because if the logic is there on the 5 minutes, 15 minutes time frame, you do not need to drop down to the 1 minute time frame because it can feel scary, it can feel very volatile, but it is tradable. You can execute on the 1 minute time frame. Or however, it takes a bit more skill. If you see your setup on the 5 minute, take the setup. You don't have to drop down. So looking at this imbalance on the 1 minute time frame, seeing how price trades in there. There's an order block right there. Fair value gap. Also know uh how they've really worked this area, this fair value gap, this BC. They've really worked down here. But notice how none of the bodies closed below it. It's quite interesting to see. You know, these are the signatures you want to see when you're bullish. Fair value gap trades down into it. Rubber bands back up, doesn't close inside. Fair value gap trades down into it. Rubber bands back up, doesn't close inside. So on the 1 minute, the 5 minutes, 15, the hourly, the daily is the same thing. Price will do the same thing, just you're looking at it fractally, you're looking at a portion of it, but it will still, this pattern they repeat on all time frames. So there's nothing to be afraid of. If you feel comfortable with the volatility on the 1 minute, because each candlestick represents a 1 minute window in time. If you're comfortable with that amount of fluctuation, go for it. If you feel okay by it, go for it. If you're into the 5 minute time frame, you like it, it takes one 5 minute candle to print five 1 minute candles. So if this volatility is okay for me, which I feel is okay, a 5 minute time frame will show you a lot, will provide you a lot of trades and a lot of logic as well. So it's just a thing of picking your poison, what you prefer as a person. Personally, I like the 5 and the 15 minute time frame. It's very, you tend to see all the levels with a good degree of clarity. It's not too small, it's not too wide of a time frame. So I found that to be what works for me personally. It fits my personality. So if the 1 minute time frame fits your personality, if you are, if you can sit through massive retracements, which are not that massive on the 5 minute and 15 minute time frame, but they look massive on the 1 minute time frame. If you're willing to sit through that, that's fine. That is absolutely fine. So, but yeah. So we have retracement back to the order block right there. There we go. So I'm going to pyramid the position. I'm going to add more to my position. So if it gets back down to this order block again, I'm going to add more because that is a change in the state of delivery. So any retracement back in can be an opportunity to add even more to the position. But it's going to be very less. I have it's going to be less than what I went in with. So that way I'm not compounding my risk. I'm reducing my risk on the way up. About 7 minutes till the news is released, and I want you to observe how the news, when the high impact news is released, and how it's being used to drive price to where it's favorable for those in the know. Drop down to a 3 minute time frame. So you see this fair value gap in here. How price respecting that. So add one more position right there because the damage has been done on the wick. The range, the gap has been balanced. Order block traded to this order block was also traded to. So just keep your focus up here. And you know, when you go at this for some time, when you go at this for a considerable amount of time, you start to see things that wouldn't have otherwise been obvious to you. You start to point out things in time before they happen. It looks as if someone see me trade. Of course, I have losing trades. I'm not nobody trades without losing, but you take a good amount of the time when you're on side, it feels like you're seeing the future, like you're literally predicting the future. Literally, this could be another trade. This retracement back in to the fair value gap would be another trade right there. But I won't be adding more to my position. But this in itself is another trade. Observing how the bodies are closing above the fair value gap. This is the signature we want to see. This is it. This is what you're looking for when bullish. Until proven otherwise, your trade idea is still valid and you can add more to your position. So 5 more minutes till till the damage is done. Now, generally, I don't. If you're starting out, I wouldn't recommend holding a trade into a news event. That is permissible if you've removed the risk from a trade. I'll say that again. I do not recommend holding a trade into a news event as it can be very, very manipulative. It can be permissible, however, if you've removed the risk from a trade. What do I mean by that? I've taken a partial off here, I've paid myself. There is no risk on this trade. I've trailed my stop loss to above break even. So it's not just at zero. I've covered the commissions that this trade would have otherwise incurred on my broker. So it, that takes away fear of, oh, I might get spiked out. Even if I get spiked out, I'm done. Like, you've done what you're meant to do. You've done your job as a trader. So you shouldn't demand buying the very low. Even though I did buy the very low of this movie, you shouldn't demand that because it's not realistic and it's not sustainable. Over time, you might be able to do that, but initially, it's not. Don't look at me or other people trading and think that it's something to aim for when you first start out. It's something to grow into, but I wouldn't recommend aiming for that. You just need to get a piece of the move, just a piece of the cake, and be done. So I'm willing to hold this trade into the news because I do really feel they are going to drive price into this pool of liquidity. Even if it doesn't do that this PM session on Monday, there is a high impact news event on Tuesday tomorrow. So you can't expect that because I know for a fact this is not resistant. This is a target that they will use either today or at a later time during the week. So that's why I'm comfortable holding this trade into the news events. So we have about just above 10 seconds till the news is released, and we'll see how price trades going into the news events. You see, it's probably random, right? It's probably luck. See how long it took before the trade actually got closed. Now, if you're on the wrong side of this, you can cause a lot of damage to yourself. You can really wreck yourself if you're over leveraged, and these events are very manipulative. And if you don't know what you're doing, if you do not have experience doing this can be very painful if you're on the wrong side of it. So what I've shared on here, hopefully it's inspired you. Hopefully you're encouraged to study the price action today, study what has been given, because there is a lot going on here and there is a lot of insight you can glean from this. The trade is done, so you can see where I've gotten from. Took a partial, showed my stop loss, all of that business. And once your trade aligns with a high impact news event, with narrative, with something you're expecting anyway, and you're seeing these signatures in price, fair value gaps respecting price, down close candles supporting price, down close candles supporting price, down close candles supporting price, up, it gives you that added confidence in your trading, and the market is kind of showing its hand to you. So that's to show you that these things are absolutely predictable. You can predict them. It's it's like this all day long, all week long, all year long. It's never going to stop. Your duty as a trader is to take what you can and move on. Don't try and. This is very possible. This level of accuracy is indeed very possible, giving yourself enough time. But don't look at this and try and do this straight off the bat. You will wreck yourself. You will be frustrated. See it as insights. Watch the video again. Replay it. Rewind it. Watch it. Learn. Take notes. If you're not taking down notes, I said a lot of things in here that are very, very beneficial. and is really going to help you a lot. I'll expand more on this. I'll be looking to take trades like this during the week as well. I'll Don't worry, I'm going to hold your hand through everything. You just have to show up. Just keep showing up. Keep watching the videos. Keep taking notes, and you will learn. I promise you. I promise you. You will be able to do things like what you've done here, and there's really no limit. There is no ceiling as an investor. There is no limit. I've decided to risk $600 on this trade, and that comes to about that's about 2 grand, about 3 grand, almost 3 grand. So there are losing trades. I do have losing trades, and you will have losing trades, but it's about how you manage them really. So yeah. So hopefully you found this one insightful. Hopefully you're able to glean something. You're able to pick up a few things from here and apply that in your trading. With that being said, I will talk to you next time and be safe.